your vision for your business. Understand how to begin to articulate that and how to internalize it. And as it becomes more internalized, the process of developing your business is going to increase, and you as a business owner will start developing more of what you want in your business.
Patrick, well done. Well done. Well done. Financial management is the bedrock of a successful business. People come to me and they say they're struggling with their business and there's this or there's that, and it's like, well, let's look at the accounting. Because without looking at the accounting, then you don't really know what's going on. It's like you go to a doctor and they're going to put a thermometer in your mouth, they're going to check your vitals, your blood pressure, things like that. Well, that's what the accounting is. We need to see how the blood flow is going, what the temperature of the business is. And it all starts with financials. The entrepreneurs frequently think in conceptual terms. They have a great idea. And they're like, I have this great idea, and they tell you their great idea. And then it's like, well, where's it written? Oh, I don't have it written down. Why would I do it? Why would I write it down? Because they think conceptually. What they need to be doing is they need to be doing the next steps on making it real. How people make things real frequently is they talk to other people. And they look for some other person. And when they find one other person that will A, listen to them, and then B, contribute something or suggest something, they're like, wow, now I'm going. Now I know I'm on track. He thinks it's a good idea. She likes the idea. We need to move beyond that. Shauna had some great ideas the other day and that are really infusing this session, and that is that proprietorships are a great way to start a business, but they're dangerous. And I was like, wow, that's a great idea. They're dangerous, you can't stay there. Because if you stay as being a proprietorship, the statistics are, you're going to fail. So it's a race. You start as a proprietorship and quickly you get to an LLC or a corporation. You get some structure. But then as we were talking, it was like, well, you know, I know a lot of LLCs and corporations that also fail. So yes, that is true, but you need to keep going. And that's why we came up with the idea of act like a CEO and think like a CFO. You've got to have both aspects of those skill sets within you and be able to go back and forth between the chief executive officer and the chief financial officer. You have to understand your bookkeeping and your taxes and how they're constructed so that you can make wise decisions so you know the consequences of the actions that you're going to be taking. We recommend that you write your plans down in a form of a strategic plan. Well, sometimes people just call it a business plan, but there's a difference between a business plan and a strategic plan. In a business plan, it's like for a startup venture, but for a strategic plan, you've already been operating, and that's what we're doing here. That's what we've been doing, where you look at what is the history, what is the current circumstances, what's the opportunities, and where can we go from here. So we're working on how can we help you to improve your methods, because we want to help you to accomplish several things, one of which is increase the value of your business. Why? Because if a business is going up in value, it fundamentally means that it's going up in revenue or up in net profit or both, and that's going to be substantiated with tax returns. And one of the first things you're going to get when questioned by a prospective buyer is they want to see your tax returns. And if it's on an upward curve, they're interested. If it's on a downward curve, why would somebody want to buy something unless they're an expert, turnaround expert? And there are some buyers out there, but you can be sure you're not going to get much on your business if you're selling to a turnaround expert. You want to improve the competency of your staff, and you want to identify a potential buyer, and then you want to begin to elucidate those agreements in principle that will lead to the financial and the legal documents that you can gradually transfer the ownership of your business. So there's really 8 things we're going to be talking about, and that we have it, and that is timely accounting, organizational methods, that your business is organized, that your desks aren't piled high in papers, that you have separate personal accounting. And that's one of the reasons why we had Alan here to talk to you today, is so that you have a cash reserve personally, as well as a business cash reserve, that you have a retirement account personally, and that you're offering retirement savings and deferred income to your employees to increase their well-being and their ability to sustain themselves, have good lives, and continue working with you. Then we want to talk about steering your business and how using break-even analysis and a self-managing culture can help you to steer. And then we're going to talk about the KPIs, the key performance indicators, and then ongoing staff development. Because this is something, you're a leader. You're a leader and you need to inspire your team. And if you don't, then your team is going to waffle. And they're going to leave you one way or another, because people need to see a future in what they're doing and who they're working with. At this point, I'd like to bring forward Shauna, and Shauna is going to be talking about accounting principles. Shauna, thank you so much.
Thank you very much, John. Some of you already have my business cards, some of you don't. So who doesn't have my business card yet? Oh, is that sure. I've been doing book work, primarily what I do, although I do have a degree in accounting. I also graduated Phi Theta Kappa from the college that I attended to get that degree. Do I know everything that there is to know about accounting? Hardly. Accounting is a huge topic and we are not going to be covering everything. However, what I do know a lot about is bookkeeping and taxes. I've been doing bookkeeping for the last 4 years. I've been doing taxes for over 9. Taxes for individuals and small businesses primarily, but I've also dabbled in some of the bigger LLCs and S Corp taxes. So what am I going to be talking about today? Again, thinking like a CFO. Well, what is a CFO? It's a Chief Financial Officer. Well, what do they do? Somebody tell me what a CFO does in a company, in a big corporation.
They handle all the financial.
Well, they do.
Write the checks.
They can, yes.
Analyze performance factors, ratios.
Precisely. As business owners, myself being one, we need to think like a CEO, the leader, as John was saying, but we also have to think like a CFO. We have to be able to analyze what's going on in our business. And a lot of times, a business will bleed, but the business owner has no idea, and so they go bankrupt. You lose your business. And they're like, you know, I tried that business, I was just no good at it. It was because they didn't think like a CFO. They weren't looking at the documents that they were being given. They were being given all the documents. They didn't have any idea how to read them, how to be able to utilize them to their best advantage. So you're going to learn. Anybody here understand what a profit and loss and a balance sheet are good for? Anybody?
You see where you're at, how much you spent out on
Some-
expenses, and what is your revenue, cost of goods.
Analyzing performance of the business.
You can use it for that, absolutely. And it is very vital that we do use it. So we're going to go over timely accounting, organizational methods, and personal accounting. The biggest thing I come across is just about every single company who comes to me. It doesn't make any difference if they're an LLC or an S corp or a sole proprietorship, when they come to me, usually the reason why they do it is because something's wrong with their books. They're not keeping them up to date. They're not keeping them accurate. They haven't gone through the process of categorizing everything within the book. And so they have gone to their tax preparer, sometimes me, sometimes other people, and the tax preparer is looking at this and going, what am I supposed to do with this? And so they give it back to you. And what are you supposed to do with it? It's a lot easier when you go in and you set up the accounts and you set it up properly, so that way you're recording everything properly, and then keep it up to date. I know that sounds very simplistic, but actually it is probably one of the most difficult things to do in finances. You do engraving.
Mhm.
You love to engrave. Do you like doing books?
Not too much. I don't have time.
Yeah, exactly. You like doing plastics. You do what in plastics?
Injection molding?
Injection molding. That's what you like to do. Do you like doing books?
Not so much.
Massage.
I never had books till I met you.
It's important. I'm going to be going through the profit and loss and the balance sheet and be explaining to you how the different elements within both of these are going to be useful for you in valuing your business and keeping your business on track. Let's see. And yeah, okay. So we're just going to stay on that page. So, your books, your profit and loss, and your balance sheet, they're there for three purposes. The first purpose is to look back, to look at your history. What is your history telling you? If you've only been in business for a short time, maybe it's only a few months. But what has that history been telling you? Is it telling you that you're on the right path? Or is it telling you that there's something wrong here? You can also look at it to look at your present. It tells you what is going on right now. By comparing those two items, your past and your present, you can steer your company in a more positive direction. Because if something's happening in the past, has happened in the past, you found out that a certain injector machine doesn't work as well as it was advertised, are you going to go with that same company? But if you didn't know that, because you weren't looking at the financials that were telling you that you were spending more in materials than you thought you would, you didn't know that, you had no clue, and you just kept going blithely along, eventually your company's going to bleed out, isn't it? That's why we have the financial records. To be able to look at them. I mean, it really is not difficult to look at it and see that you're spending, Joanne, more in your massage equipment than what you thought you were. Or your supplies. Maybe your supplier just raised their costs. You didn't know about it. And now all of a sudden, instead of paying, how much do you usually pay for, say, just something in general?
So like for a gallon of oil, $52.
Okay, now let's say that your supplier decided to raise that to 75. And you had absolutely no idea, you just went on ordering and ordering and ordering and ordering. Would that hurt your business?
Yeah. I'd have to raise my rates to offset that.
There's another thing that you could do. Find another
Another
supplier.
supplier.
These are the things that history tells us. Because you can compare the history to the present. So then you take that and you look into the future. Where do you want to go? That's the profit and loss. Profit and loss basically tells you how much you're earning, what your expenses are, what your cost of goods is. Does everybody know what cost of goods are? Okay.
Cost of goods is our product that we buy to turn around and sell,
Well,
Or
that
resell, or
actually,
or for part of your main.
Sort of.
Variable costs that go into direct, for me, manufacturing of the product.
Right.
Or what it takes to, if you're in a service industry, what it takes to provide that service. You know, hiring contractors, things like that. So you subtract out from the money that you're bringing in your cost of goods. You subtract out your expenses, which is different from your cost of goods. You need to keep those two separate. Your expenses are things like your computers, your pencils, pens, papers, oils, materials to, not to build,
Right.
but the things that you're just selling on a retail basis. Things like that go into your expenses, your internet, your telephone, your heat, your electricity, your building. All those things are your expenses. So you subtract that out of the money that you're making, and that gives you your net profit. And it's simplified. Your accountant actually uses a lot of different formulas. We're going to go over a few of them that actually provide a more comprehensive idea, but that gives you an idea that you can use on a day-to-day basis. Bringing your awareness of what your company's doing closer to a CFO. So that way you can do that. And once you understand that, being able to train your people to do the exact same thing. Teach that manager, teach that other person who you want to take over the business to use those same tools and be able to report back to you the condition of the company. Wouldn't that be great? You don't have to do it. You can have somebody else do it. They can just tell you what's going on. And then once in a while you review the materials just to make sure that they're not, you know, people are people. Just saying. But wouldn't it be nice to just be able to step away? I think that would be great. That's what I'm working for. To the day when I can just step away and know that the reports I'm getting from my manager, from whoever it is that I'm having take care of that end of my business, that they're giving me accurate information. Balance sheet. Balance sheet is important. It's just as important as your profit and loss. But a lot of people do not understand that there are a lot of things that go into a balance sheet and some things that aren't necessarily on a balance sheet, but they're still considered a part of it. There are things in a business that are called tangible items, things that are intangible. We're talking about your assets. Your assets are what that lender is looking for. You've got positive assets and you've got negative assets. You've got liabilities. And believe it or not, you have positive liabilities and negative liabilities. And then you have things that don't even show up at all, but they're valuable. They're very, very valuable. Now, the obvious assets that you've got are the things that you can touch, the tangibles, the things that you can see, desks, chairs, printers, signs, people, as in employees, they're valuable. And yes, we can put a dollar number on that. Goes right into the balance sheet. Yay, we know that. That is fantastic. And then you have your intangibles. The things that can go on a balance sheet, but don't normally do. Can anybody think of an intangible that would be important to a business?
Client.
Receivables?
Your receivables will go onto a balance sheet. I'm
Oh, that
talking-
don't go on the balance sheet?
Yeah. Things that actually do.
Uh,
Your clients is one, your client list is one. You know what one most business owners forget every single time? Your business name. Your business name, your reputation is probably one of your biggest assets. You're going to sell that or trade that or do something with that sometime in the future. At least I hope that's what you're going to do, because that's why you're taking this class. So you want to make sure that you've got a good name. Very, 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 very important. There are other intangibles. Research and development, R&D. Most people don't think about it. It does not go on the balance sheet. Except for in that part where it says this doesn't really count. If you have R&D, that's valuable. These are things that investors are looking at besides what they can see on printed paper. And it's assets that you can sell when you turn your business around. Or that you can, when you do the transfer that somebody else gets to do. Just recently, as an example, I went to have my vehicle looked at by one of the local auto shops in town. The name of the auto shop was kind of a little bit misleading because it says that they do one thing. Now, I took it in there. I didn't take my car in there to have them work on that particular part. Comes to find out, they're actually a general automotive place. So when somebody else goes to buy that, they're actually buying the customer list and the company name. The company's been in business for over 50 years. He said, because when I spoke to him about it, I said, you know what? The name on your business is kind of a little bit misleading. He said, how so? I said, you don't just do this. You do it all. He said, well, yeah, but when I bought the company, it had already been in business for a long time. And so he just didn't want to change the name because everybody knew the name. So always keep that in mind when you're thinking about transferring the business and moving into either, well, a transfer or a sales situation. Okay. That's assets. Another asset that a lot of people don't really think about is your accounts receivable. Most people think of accounts receivables as a liability. It is not. It is an asset. When banks and lending institutes look at your accounts receivables and they are within a short period of time, but they're consistently being paid off, what does that tell the lending institute?
Tell them that you've got money coming in.
You're a safe bet.
Exactly. You're a safe bet. So when it comes time to, when you need that infusion of a little bit of extra money because, oh my goodness, you found this really sweet deal. I mean, you really got it, but you don't have the cash now, but yet you've got a nice accounts receivable, and the rest of your accounts are all in order. That lending institute's going to be more likely, I should say, to give you the finances that you need, knowing that you can pay it back, or at least you have the ability to. Now, liabilities. Okay, liabilities can be an asset. Generally, they're not. On the balance sheet, they're not. They're liabilities. Liabilities means that you're liable for them. But here is how they become a positive aspect in your business. You have money out that you're paying for on a regular basis. Accounts payable. Accounts payable. Paying. All the time paying. As long as that does not get out of line, and it doesn't get so big that you are no longer able to make those payments, guess what else the banks and lending institutes look at? Your ability to repay. If you have a history of being able to pay back your loans and pay back those items that you have outstanding, they are going to trust you a little bit better. You can have long-term and short-term accounts payable. Long-term would be things, like owning a building. Short-term would be more like your credit cards that you use. It's always a good idea to have something on credit cards. Just don't let it get out of hand. Accounts payable can easily get out of hand. So you definitely want to be watching that closely. But if you do it right, there's an insurance company up in Longview. She's just about ready to do the transfer. In fact, I'm trying to make it possible so that way John can talk to her. She wants to retire. But her big thing has been that when it comes to credit cards, she got this great big huge loan. And she used the credit card to get the things that she needed. She put the money, she made the charge, paid it off. The loan was at a really low rate, so she never had to pay the interest on the credit card, because she was always paying it off right away. She got one of those cards where you can get business miles. She's been able to fly to Hawaii. She's been able to fly overseas. She's been able to take vacations within the United States. Wouldn't that be wonderful? That is the proper use of accounts payable. Being able to take advantage of being able to step back and say, I can do this. I can take a vacation. I can take some time off. I don't have to worry about it. My business is still going to function. Okay, so does everybody understand profit and loss and balance sheets to a degree? Okay. When it,
I have
yeah,
a
go ahead.
question. If you have a corporate card and you're doing that to build miles, and then you take those miles for personal use, does that have to be considered income? Personal income?
It depends on how, if it's fully personal, yes, that does. But if you're smart, you figure out how to be able to turn that into a business transaction, so that way all those miles then become a business deduction, and you can still have your fun at the same time.
Plus the meals, other things.
Yes. And that's a wonderful, beautiful tax question, because that is important. You gotta understand also that anytime you have an accounts payable outstanding and somebody forgives it, guess what that just became?
Income.
You got it, income. Yeah, a lot of people don't know that. If you're going to have anything forgiven, please talk to a tax specialist. And I'm not talking, your average tax person, somebody who's been doing taxes for a while. And speak to them before you actually do that, so that way you know what the consequences are on your tax return. Very important. I've seen people actually go under because of that, just from one forgiveness. Okay, revenue, cost of goods, revenue less cost of goods, less expenses. When you have revenue, less the cost of goods, less expenses, you have what? I already gave you the answer, so
Net profit.
there you go, net profit. Assets plus going concern less debt gives you
Equity.
You got it. You've been doing accounting for a little while. Most people don't get that.
I am the CEO and CFO.
And the CFO. Okay, these are just some of the formulas that an accountant uses to be able to do a valuation.
What's a going concern, what's that mean?
The going concern is a concept that I'm going to let John explain, because when he comes up, he'll be able to explain that, because that's a part of what he's going to be talking about a little bit in his presentation. So I'm going to leave, if you don't mind, me leaving that question
Great.
to this point. So, there are a lot of different formulas that go into valuing your company. But when it comes to driving the company or steering the company, the top one is really the one that's going to help you out the most. When it comes to actually transferring, the second one. And personal accounting. When it comes to business, I can't stress it enough to keep your personal accounts separate from your business accounts. Too many times, people, especially sole proprietors, are notorious for this. They have an account, in fact, they might even have two accounts. But yet, instead of keeping them separate, oh my goodness, I gotta go down, okay, so I need to pick up some paper and some pens and a stapler. And let's see, while I'm here, I might as well get that trash can for the living room. And I need to get, do you see how it's starting to merge? Then they get to the cash register, and it's okay to make one trip. But then they put it on what?
Business.
One card, the business card. It never goes on the personal card. So then what happens? You take all of your documents into the tax preparer, and what do they say?
How did you use this bread and milk for business purposes?
Yeah, and was this for meals? Was it for entertainment? And you're sitting there going, oh my goodness, that was back in January of last year. You don't remember. Because you didn't keep the records straight. You didn't keep the accounts separate. And now all of a sudden, you get your tax return, you send it off to the IRS, and now you've got the IRS calling you. Well, first they send you a letter. We need more information about this on your tax return. What happens when you get that letter from the IRS? What's the first thing that happens?
Right.
Your blood pressure goes right through the roof. So then what's the second thing you do? You go running to your tax preparer and going, why did I get this? And then they will say, well, it's really very simple. All we got to do is just send in the information that you provided for me. So they send off the information that you provided to them, to the IRS, and the IRS says, no way. No way. Those were personal expenses that you're trying to deduct on a business account. So now we're going to hit you with some fees and interest, daily interest, not monthly interest, daily interest. And let's see, they usually